Now, we generally record liabilities at their face amount, whatever it says we owe. If we borrowed $100,000 and gave a note for $100,000, that's the face amount. We sometimes get to a situation where our situation, financial situation, has deteriorated, and our creditor will accept less than $100,000. Okay, and we might want to change at that point. There's also occasions when the creditor is suffering through financial woes and will take less for the debt to be paid, and we would want to record that as well. Okay, questions so far? No? All right, accounts payable, trade accounts payable, obligations to pay for goods or services that we've acquired for use in the business. The next category is accrued liabilities or accrued expenses, obligations related to expenses that have been incurred but not paid. The difference between accounts payable is accounts payables are invoiced. There's a writing saying you owe these. Accrued liabilities or accrued expenses, there is no invoice. We know that we owe them, so we're going to record them due to that fact. Deferred revenues, unearned revenues, we've talked about this previously. We have received cash but not delivered what we're supposed to deliver. It's a liability because we must pay that back to the person if we cannot deliver. Lastly, notes payable. So alternative term for notes payable. Obligations supported by a formal written contract. And I think I showed those to you, or a note to you a couple of weeks ago, where it's a written promise to pay, setting forth the interest rate, the due date, the amount, etc., and signed by the borrower. The instrument needs to be signed by the borrower to be valid. Okay. Now, there is an accounts payable turnover, and we call it our key ratio for this chapter. Accounts payable turnover is measured by the cost of goods sold divided by average accounts payable. Now, what this assumes is that all of our cost of goods sold are bought on account. And for businesses, that's pretty much standard. Businesses buy and agree to pay later. It's B2B, and they work on a different system than you would be able to get away with as an individual. You can't walk in and take off with something and say, I'll pay you later. You'll probably never make it out of the store before the alarm goes off. Okay, on the, so we take the cost of goods sold, assuming all goods are purchased on credit, divide by the average accounts payable. Again, beginning of the year plus end of the year divided by 2 gives us the average accounts payable. If we have a high payable turnover, suggest the company's paying its suppliers in a timely manner. Going back and thinking about what we were discussing with Walmart, Walmart has a very high accounts payable turnover ratio because they don't record the payables till they get ready to pay them. Okay? And then they pay them off. A declining accounts payable turnover indicates that the company is probably acquiring or getting into financial distress. They're taking more and more time to pay off their vendor. This is an indication they're running out of cash and just can't pay them. We take the 365 days, divide by the accounts payable turnover ratio, and that gives us the average number of days that our payables are outstanding. How long does it take us to pay off our payables? Most payables are due within 30 days. So this average number of days payable needs to be less than 30 days. And if you're monitoring your own company, you want to make sure that you are staying less than 30 days. It keeps your creditors much happier with you. They'll keep extending your credit, etc. You can ride the creditors for a little while, but they will eventually stop selling to you, and then you're kind of up the creek. So you don't want really to irritate your vendors. You want to keep them happy. You want them to be selling you things, extending your credit, etc. Payroll taxes, very simple.